Following our discussions in previous episodes on potential entry points for trades in relation to mean reverting and breakout strategies, today I look at trend continuation price action and how that can potentially be targeted. Back after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. In a similar way to showing you how I think about trade entries for both mean reversion and breakout strategies that both avoid chasing price, what I show in today's episode in relation to trend continuation will also avoid chasing price. Let's take a look. So I've been speaking about the principles of designing new trading strategies within the context of a trader evolution. And right from the very beginning of that, you're going to be thinking about the development of your first strategies. So having covered two types of strategy already, let's now move on to the third, trend continuation. So this is the price action that we looked at in the previous two episodes. We had this ranging period of price action here, which is actually in a slight down channel. But I consider that exactly the same concepts can be used in terms of trading this type of behaviour. But all ranges and channels must come to an end at some point, and usually that happens with a breakout that we see here. And I showed the principles that I consider when trading a breakout, which is not to trade on the actual breakout itself, but to wait for a pullback. And it's much lower risk because at this point we can confidently see that a good breakout has occurred. Whereas if we're trading earlier on when the price initially comes out of the channel, this could be a false breakout at this point. And following this, the trend emerges. But this pullback behaviour is not a rare occurrence. It's very common. So if we move along here, we can see exactly the same behaviour here. So we have a sideways channel with the price moving up and down between support and resistance. And then look, the price breaks out, pulls back to this level here, which was resistance and is now acting as support, which then sends the trend on its way. And again, exactly the same here. We have a sideways channel, a breakout, and this time if you missed the first pullback, you'd actually get a second opportunity as the price comes back and hits support for a second time. And then again, the trend starts on its journey. So if you missed the pullback following the breakout here, have you now missed the opportunity to get in on this trend? Well, no, there are ways of doing this. But again, you must try to avoid the temptation to chase price. So as the price is coming up here, this is the worst place you could get into this trend. And that's because as many traders start to get their attention pulled to this trend, that usually means you're late to the party in getting in. So how do we open our position into this prevailing trend? Well, the way I do this is by considering exactly the same principle that we did with the breakout here and waiting for this pullback. There is a difference when getting into the trend, however, because here with the breakout pullback, we have this line of support and resistance to guide us. We have no such thing here during the pullback of a trend that's already underway. However, there are certain ratios that tend to be extremely common, and these tend to be between 30% and 70% in terms of the percentage pullback compared to the previous impulse wave. And so a pullback between those range of percentages often provides a good entry point into this trend. And in this particular case, you can see that the pullback is approximately 50% of the distance from the top of the range to the maximum height reached previously. So we could enter at this point here in the hope that the trend would continue in an upwards direction, which obviously in this case it does. So let's take a look at some of the others. So here we have the impulse wave up to this point, and then again we have a pullback which is probably just a little bit over 50% in this particular case, probably more like 55. But we could have entered either at this point or this point here, and we'd have been able to catch the continuation of that trend. Let's move to the original one that we looked at. So this is slightly different. Here, the trend does continue in an upwards direction, however with much less volatility than in the initial phase of the breakout. And in this case, it might not have actually given us an opportunity to enter based on those principles we talked about before. So we have the breakout, and initially we have a pullback here, which is probably more in the region of 20%. So this is a pullback that I personally wouldn't have taken. We then have a continuation up and another pullback. But again, the size of this in relation to the initial impulse probably isn't big enough for me to get into. If you had, you would have made a profit, of course, but much more slowly than the other two examples. So coming back to the previous example here, let's think about this in terms of following the crowd and also chasing price. So as we said, our entry point would be based on a pullback of the original part of the trend. So we'd be entering a buy order somewhere here, but look at the immediate price action. That's actually coming down. So your trade is in the opposite direction to that immediate price action. And so once again here, you're doing the opposite of chasing price, and you're doing the opposite of what the majority of traders have been doing during this time, because obviously it's an excess of selling pressure that has caused this dip or this retracement. And so by getting in at this point, you'd be one of the first traders to go against what the crowd is doing at this point in time. But then other traders would join you, and obviously that's what happens in this case as the price gets pushed up by an excess of buyers over sellers. And it's this contrarian view in terms of how the price action works that I tend to take in all of my trading strategies. So as part of the consideration of designing new strategies, I've only really considered half of the story, and that's the trade entry. But if anything, that's the least significant part of the story. I would consider that the trade exit and the rules you have for that is far more important in terms of producing a profitable strategy. And so in the next episode, I'm going to look at the principles again that I use personally to decide where the exit point should be for all three types of strategy that we've looked at so far. So be sure to tune in to that episode. If it's already available, then you'll see it top right now. But now until next time, trade safe.